Hello everyone. Okay, so we're going to continue here in Chapter 4. And in Chapter 4 we're going to continue from where we left off in Chapter 3. If you recall, in Chapter 3 we talked about recording the transactions in a general journal. They're called the journal entries that we record in the general journal. And then we post that activity to the individual account ledgers. And from the running balances in the account ledgers, we prepare a trial balance. And so what we're going to do in this chapter is we're going to take that trial balance. So we've been through all of that process, the journalizing, the posting, the preparation of the trial balance. And so now we're left with this trial balance. We have all the running balances in the accounts. And basically we look at all the account balances and we go through an adjustment process. There are situations where those account balances need to be adjusted. All right, and so that's what we're going to work on here during this adjustment process. And as we said in prior chapters, revenue is recognized when it's earned, regardless of when we collect cash. So there is a timing difference between cash flows and the recognition of revenues and expenses. I also should say expenses are recorded when they're incurred, regardless of when we pay cash. So we're going to have these accruals and these deferrals, and they're basically the accounting, those are the accounting adjustments that we typically need to make. So in Chapter 3, once again, we recorded the transactions in the journal, and then we posted those transactions in the ledger, and then we prepared the trial balance. And so what we're going to do here is we're going to go through the adjustment process. There are typically 4 types of adjustments. Number one, and we're going to go through all 4 of these. Number 1, where we need to convert an asset to an expense. Number 2, where we need to convert a liability to a revenue. And number 3, we need to accrue for unpaid expenses. And number 4, we need to accrue for uncollected revenue. So these are the 4 adjustments. So number 1, converting an asset to an expense. There are times where we purchase an asset, and that asset will benefit more than one accounting period. And so what we typically do when we buy the asset, we debit the asset, and if we bought it with cash, we'll credit cash. Now, if that particular asset benefits multiple periods, what we need to do is we need to adjust some of that asset over to an expense. Okay? And the second type of an adjustment is when we convert a liability to a revenue. This isn't the case typically when we get paid beforehand from our customer. Our customer pays us in advance. Well, when they pay us in advance, that's a liability, typically called unearned revenue or customer deposit. And then obviously as we earn it, we're going to reduce that liability and record the revenue at the time. The third type of adjustment is where we accrue for any unpaid expenses. Typically that's with an interest or a wage expense or a salary expense. A lot of times the end of the month comes and the end of the year comes and our employees are halfway through a pay period. So they earn some money, some days that they work, but they're not going to get paid until the next period. Well, we got to make sure that the few days that they did work in the year gets recorded as an expense for the year, even though they're not going to get a paycheck until the following year. Same thing with uncollected revenue. Sometimes we are providing a service to a customer and we don't bill them by the end of the month, comes and goes, and we have to realize, oh yeah, that service that we provided, even though we didn't bill them yet, or even though we didn't, even though we didn't try to collect it yet, we still have to record the revenue in the appropriate period. All right, and let's take a look at some examples. All right, so let me see. First one, converting assets to expenses. All right, a good example here is where we pay cash in advance of incurring any expense. That creates the asset. And then during the current period and the future periods, we're going to reduce that asset as it gets used up, and we're going to increase the expense. Here's the example of an insurance policy. Say we buy an insurance policy that covers 12 months, and the cost of that policy is $18,000. Well, if you take the $18,000 and divide it by 12 for 12 months, you get $1,500 a month. So say on March 1st, we're sticking with our same company, Overnight Auto Service. They bought a one-year insurance policy for $18,000. Well, on that day, March 1st, we have an asset, and that asset is called unexpired or prepaid insurance. Actually, the word prepaid is more common in industry than unexpired. But the fact of the matter is, you have to know that on March 1st, when we bought that insurance policy, that is an asset. And we wrote a check, so we're going to reduce cash. And cash is going to get reduced with a credit. All right, now, if we close our books and we prepare our accounting on a monthly basis, at the end of the first month, what we have to say to ourselves is 1/12 of that insurance policy has expired. It's gone. So 1/12 of the $18,000 or $1,500 is no longer an asset. In effect, we've used it up. Another way to say this is we've incurred insurance expense. So you can see at the end of the month on March 31, we are recording or increasing our expense account. And as we said in prior chapters, expenses reduce equity. Therefore, expenses are going to be recorded with debits. And my asset is being decreased. The asset is prepaid insurance or unexpired insurance. So that is an example of the first type of adjustment. All right, and you can see the effects here on the balance sheet. On March 1st, we did have an asset called prepaid or unexpired insurance. It had an $18,000 balance. And then on March 31st, you can see this journal entry that we just went through. What did we do? We reduced the unexpired or the prepaid insurance with a credit, and so the running balance at this point is $16,500. And the expense on March 31 was recorded at $1,500. Now, bonus question before I move on to the next slide. We have a running balance of $16,500 in the asset account. At the end of 12 months, what is the balance going to be in the asset? I'll give you a few seconds to think about it. And for some of you that said 0, you would be correct. At the end of 12 months, the policy period would have expired. Therefore, we do not have an asset, and that is the whole idea. Okay. Next, once again, this is the same type of adjustment where we're converting an asset to an expense. What we're going to do is we're going to use the concept of depreciation. Now, depreciation is simply a cost allocation method. What we are doing is we are taking a piece of that asset and we're converting it to an expense over its useful life. So, the example is, let's say an automobile. We buy an automobile. That's an asset. And when we buy it, what did we do? We debited the automobile account. An automobile is a fixed asset. A fixed asset is a term used in accounting world for all of the longer term assets, the property, the plants, and the equipment accounts. So if you ever hear PP&E or property, plant, and equipment or fixed asset, they all mean the same thing. And so that account was, when we bought it, we increased that account with a debit, and assuming we bought it for cash, we'll reduce cash with a credit. Now, as we use that fixed asset, over its useful life, a piece of that asset is going to be recorded as an expense. So we are going to increase the account called depreciation expense. And instead of crediting the fixed asset account directly, we're going to credit a contra asset. A contra asset is basically an asset that's attached with the fixed asset. Contra, and for those of you that speak Spanish, you know the word contra means it works against. It's against. It's the opposite. So the contra asset is called accumulated depreciation. And I'm going to show you in a few minutes, for financial statement purposes, we're going to take the debit in the fixed asset accounts and the credit in the accumulated depreciation accounts, and we basically put them together to show a net number, one net number on the financial statements. Okay, now let's put this into action. On January 22nd, let's assume Overnight Auto Service purchased a building with a useful life of 240 months. That's 20 years. For $36,000. And we're going to use straight line depreciation. What that means, straight line, if you can visualize a straight line, it means there's no, it's straight. It's the same, basically every time period. That's what straight line means. There's no ups and downs. And here's the formula for straight line depreciation. The numerator is the cost of the asset, and so in this case we bought the building for $36,000, and the denominator is going to be the estimated useful life. So in this case this is 240 months. And if we do the math, 36,000 divided by 240, that works out to $150 a month. And so what we're going to do is we're going to record depreciation expense of $150 a month. We're going to do the same thing for 240 months. The same thing for 20 years in a row. Okay, here is what the journal entry looks like. So on February 28th, which is the first month that we actually owned the assets, you're going to see that we're going to increase the expense, and we do so with a debit. And instead of crediting or reducing the building account directly, we're going to credit the building's contra account, and that is called accumulated depreciation. And here's your transaction explanation to record 1 month of depreciation. Okay, this is a contra asset, the accumulated depreciation. Okay, here's a second example. Overnight depreciates its $12,000 of tools and equipment over 60 months. So if you take 12,000 divided by 60, you get $200 a month, and you can see it's a very similar journal entry. We're going to increase the depreciation expense with a debit, and we will credit the accumulated depreciation. This is the contra asset. All right, so what I wanted to show you is just a portion of what the balance sheet would look like. And remember, as I said a few moments ago, what we're going to do is we're going to take the building account and not show the building account of $36,000 on the balance sheet. We're going to show the building less its contra asset, the accumulated depreciation. This is the depreciation for the full 2018, 11 months worth of depreciation. $36,000, which has a debit balance, less the accumulated depreciation. And once again, the contras have the opposite balance, so the contras have a credit balance. And so your net debit is $34,350, your net building. Tools and equipment had an $18,000 balance, and we depreciated it $2,200 worth. Debit balance for the tools and equipment, credit balance in the accumulated depreciation. The net debit, this is the amount that we're going to show on the balance sheet. And the amounts that are shown, the building, the fixed asset less its accumulated depreciation, the net between the two is called book value. All right. Now, a couple of things I want to point out before we move on. Depreciation is simply a cost allocation method. It is simply a method to move the cost of the asset over to the income statement as an expense over its useful life. Now, some students get confused because when they hear the word depreciation, they're thinking in terms of the market value is actually going down. That is not the case. So whenever we talk about depreciation in this course, all we're talking about, or in accounting in general, if you're talking about depreciation to an accountant in general, you're talking about a cost allocation method. You are not talking about increases and decreases in the market value, the fair market value of the asset. That is completely separate and distinct from what we're trying to do here. Okay, that was the first type of adjustment, converting an asset to an expense. The second type of adjustment, converting a liability to a revenue. And the good example here is when we collect from our customer in advance of us doing anything for that customer. All right, so let's take a look. On December 1, Overnight received a $3,000 in advance for a 3-month rental contract. So what we've done is we've rented some space at our garage. You know, you've seen this around where some commercial vehicles are parked at a gas station overnight. Now, they pay rent for those spots. And so that's exactly what we have going on here. And we signed a contract, a 3-month contract with an individual for a rental. And so if you take $3,000 divided by 3, that's $1,000 a month. All right, and so on December 1st, we signed that contract. So on the first day that we received that $3,000 on December 1st, if we take a look at our journal entry in the general journal, we increased our cash account with a debit of $3,000. Now, on the day that we received that $3,000, we did not earn 1 penny of that. So we're going to record a liability. And that liability is going to be called unearned rent revenue. Some students like to use the term customer deposit because it's a little bit easier for them to understand that way. I am totally cool with it either way, customer deposit or unearned revenue, whatever floats your boat, as they say, whatever it makes sense to you, as long as you know this is a liability. And it is. As of December 1, this is a liability. That is a debt. We owe that back to them until we earn it. And so over time, that liability becomes earned. And so 1 month goes by. So on December 31st, what we need to do is we actually need to record an adjusting entry to reduce that liability. Liabilities get reduced with debits. So we'll reduce that by 1/3 of the $3,000 because it was a 3-month contract, or $1,000. And on this day, December 31st, we can say we've earned our money. So we're going to credit the revenue account. Revenues increase equity, which are increased with credits. Okay, and so we can see this is what the financial statement looks like as of December 31. We originally had a $3,000 liability, but after we reduced it by $1,000, the running balance on December 31st, if we were to prepare a financial statement, a balance sheet on that day, we would show a $2,000 liability. And if we were to prepare an income statement for December, we would show that there was $1,000 in rental revenue. Okay. The next type of adjustment is to accrue for any unpaid expenses. This is where we haven't received an invoice, or maybe we did receive an invoice, but we didn't pay it just yet. All right, we need to recognize the expense in the proper period. Good example of this would be with wages, because a lot of times we pay our employees on a weekly basis, sometimes on a bi-weekly basis, and gosh, I've even seen some companies pay on a semi-monthly or a monthly basis. All companies have different methods of payment. So in our example, Overnight, we pay wages on a weekly basis. And so what happens is our employees worked Monday through Friday, and at the end of the work week, they're going to get paid on Friday. All right, and the last week of the year, the last day of the year, I should say, falls on a Tuesday. So Monday, our employees worked Monday through Friday. On Monday and Tuesday, as you can see on this slide, they earned collectively $1,950. They're also going to work Wednesday, Thursday, and Friday. All right, January 1st, 2nd, and 3rd. All right, and so what we're going to do, remember, December 31st, we have to prepare financial statements. So we have to say to ourselves, heck, I know our employees worked Monday and Tuesday, but we don't have to pay them until Friday, which is literally the next year. So what we need to do is we need to accrue for the wages on Monday and Tuesday. Remember, the expense needs to be recorded in the period that we incur it. Our employees earned that wage in Monday and Tuesday, in December 30th and 31st. That needs to be an expense reported in December. And so the journal entry is going to look like this. On December 31st, this is what we need to record as an adjustment. We need to record the wages expense for $1,950. And today's not payday, so we have this liability called wages payable. And remember, liabilities are increased with credits. So that is a good example of accruing an expense. This is what the financial statements would look like on December 31. When we issue our financial statements, we would indeed show a liability on the balance sheet for the wages payable. All right, I think this should say $1,950. I think this is a typo here. And then the income statement, we would show the wages expense for the $1,950. Now, let's take it one step further so you understand the full loop here. Now, on January 1st, 2nd, and 3rd, our employees earned collectively $447. I suppose it's a lot less than Monday and Tuesday because maybe the garage was closed for the holiday and whatnot. So anyway, let's take a look at the actual journal entry when we write our we pay our payroll of $2,397. So here's what the journal entry looks like on January 3rd of the next year. Cash is going to be reduced by the full $2,397, but let's think about what was paid. Well, $447 for January was paid. That is an expense in January. We are in January. It was incurred in January. It's an expense. But remember, at the end of December, we had this liability called wages payable from the prior adjusting journal entry. So we're going to reduce the payable. Payables are liabilities. They get reduced with a debit. So you see, this is a compound journal entry where we're recording. You can see 3 accounts are affected. But indeed, the total amount of the debits equal the total amount of the credits. Okay, and the last type of adjustment is called accruing uncollected revenue. All right, that is when we collect on a receivable. Let's take a look at this. On December 31, Airport Shuttle Service owes overnight half of its maintenance agreement. So here's an example where we signed a $1,500 maintenance agreement, or I should say our customer, Airport Shuttle Service. They sign an agreement with us that says, hey, we'll pay you $1,500 a month just so you repair our vehicles whenever repair is needed. That was signed on December the 15th, as you can see here. So for 1 month, December 15th to January 15th, is $1,500. But remember, December 31st, we stop and say, hey, we're preparing financial statements. So how much of that $1,500 in the maintenance agreement was earned? So half of it, December 15th to the 31st. Remember, it's a monthly. So half of the $1,500 is $750. $750 of that was earned in December. So in December 31, what we need to do is record the revenue, and revenues are recorded with credits. That increases equity. And we didn't get paid, so instead of recording the cash, we have to actually increase the accounts receivable account. That is an asset, and that is going to be increased with a debit. All right, and so the balance sheet at this point, if we said timeout, the balance sheet would show the $750 in receivables, and the revenue, you're going to show the $750 as well. All right, now on December 15th, when our customer pays us the $1,500, we're going to increase the cash account. Cash is an asset. It'll be increased with a debit. And what do we got? Well, what is the $1,500 the payment of? It's payment of the $750 receivable. Remember, in the adjusting entry, we recorded that as a debit. So this is going to be credited to reduce it. And the other $750 is earned today. Okay, let's move on. So this is the last type of adjustment. Sorry, went a little too far. And of course we have income tax expense. This is I'm sorry, everything's acting up here. And one of the last adjustments is we have income tax expense. Income tax expense, of course, is something that we would figure out at the end of the period. Okay. All right, a couple of other concepts before we wrap this up. Materiality. Everything we are talking about in this, in accounting in general, deals with materiality. All right, we are going to make adjustments if it makes a material difference. All right, so as an example, if we're talking about we're off by $2 and we have total assets of $1 million, do you think we need to find a $2 issue? Of course not. It does not really change a decision maker's decision on whether that $2 was included or not. So materiality, we need to make sure that accountants need to make sure that all material items are properly reported in the financial statements. If we're talking about something as immaterial, all right, immaterial items are those of little or no consequence to decision makers. All right, if that is the case, it doesn't matter if it's recorded or not. And we don't want to waste time on immaterial dollars. So make sure the concept of materiality will enable accountants to shorten and simplify the process for making adjusting entries. We can really just concentrate on the material items. That's basically what's talking about here. Okay, this is basically a summary of everything we looked at with the effects of the adjusting entries. And here is the last slide I want to show you right now. If we take a look at this, we left off with Chapter 3, dealing with a trial balance. And what we did is we took that trial balance and we adjusted it. And everything you see in red here was adjusted. So you can see how many accounts were actually affected by the adjustment process. As a matter of fact, just taking a look at the adjustment, just taking a look at the amount of red that I see on this slide as compared to blue, I'm here to tell you that it looks like more accounts were adjusted than not adjusted. So this proves to you that the adjustment process is very, very important in the whole scheme of things. If you ever work in a corporate office and you have some friends in the accounting department, typically they're busy in the beginning of the month, right? The first week or so of the month. And sometimes you ask them, let's say you ask them to go out to lunch and they say, sorry, we're busy. We're going through the month-end closing process. They're talking about this. They're going through the adjustment process so they can prepare the financial statements and then ultimately close the books, which is the next part in the accounting cycle. And we're going to talk about that in the next chapter.